Hello, you beautiful people. Welcome back to the Long Term Podcast. I'm your host, Advin Villa. Today, we have mortgage specialist Lincoln Sharpe. We will discuss current trends in the real estate market, mortgage financing tips for first home buyers, using mortgage loans to make financial progress. Everyone, welcome. Thank you so much for coming on the Long Term Podcast.
Happy to be here. Thanks for having me.
Lincoln Sharpe, everyone. Very excited to talk about the real estate market, mortgages, and so first off, tell me a little bit about yourself.
Sure. So I'm from small town Alberta, a town called Tofield, Alberta. Went to high school there, played a little bit of basketball. Right after high school, I moved to the city, went to NAIT, and that's where I got my degree in finance. During my time at NAIT, I worked for one of Canada's non-bank lenders, one of the largest non-bank lenders in Canada. Spent a lot of time in subprime financing, did a little bit of mortgages, a lot of personal loans. And then I moved over to the Bank of Montreal, spent some time there as a personal banker doing a little bit of everything. So investments, bank accounts, credit cards, mortgages. And just fairly recently in the last 5 to 6 months, I specialized in mortgages.
Did you always know you wanted to do this type of work?
Yeah, I think I've always been interested in finances. Even from a young age, just messing around with compound interest calculators and trying to plan my future as early as I could and seeing how that could play out. And then, pursued my education. I actually wanted to be an accountant. So I went to NAIT. It's a general program. My very first class, I sit down accounting 101, whatever it is. And within 20 minutes, I'm like, there's no way I could be an accountant. This is not going to happen. So you just learn through the program what you do like, what you understand really well, and what you want to go with. So it was kind of a toss up between marketing and finance. And I ended up going the finance route, and I'm happy I did.
Yeah, man. What's what made you gravitate towards it? What's one thing that just you knew this is something you wanted to do?
I think I would have to chalk it up to that compound interest calculator. I believe it's Einstein said it's the eighth wonder of the world, compound interest. And it's true, right? Interest over time compounds, and the results can be pretty outstanding, even on a small amount of money going in. But with a decent rate of return, a good amount of time, and some consistency, it can grow into a lot.
Yeah. For the people that don't know what compound interest is, can you explain?
Basically, what that means is interest on top of interest. So let's say you have $100 and you get a return of 10%. Well, that'd be $10, but it's compounded. So the next year it's 10% of 110, and then you add that in, and then 10% of that. So it's kind of like, 2 times 2 times 2 times 2. If we could get 100% returns per year, that would happen pretty fast. But ideally you target 7, 12%, and hold it for the long run, and it can turn into a lot of money.
Yeah, there's that chart where if you multiply a penny by itself over like 20 years, 30 years, it's just such an insurmountable amount of money. Hey, it's amazing. Just the compound interest, what that can do. And a lot of people that have a lot of money lose so much having no knowledge of that, because it's just your money is working for you. And I think Warren Buffett has this quote of, if you don't find a way for money to grow for you, then you'll work every day of your life.
Yeah, you can either work for money, which I think we all have to do at some point. Yeah. But once you kind of get over that hump, at some point, hopefully your money starts working for you.
Yeah, it's beautiful, man. And let's talk about the current trends in the real estate market.
Sure. Yeah. So, I don't pretend to be any kind of expert in the area. I'm not a real estate agent. I'm a mortgage guy, but I see it. And I did bring in some stats. So detached homes, so single family dwellings, are up 6.8% year over year. Semi-detached, so townhomes, are
up 6.8%.
6.8% in price.
And that's all of Canada?
No, that's the local market around Edmonton area.
Okay.
Yeah. Semi-detached, so townhome style, up 8.4%, and even condos are up 6.9%. So the average detached home, 546,000, semi-detached 414, and apartment style condos at 206,000.
Jeez. And then with the rising prices in food as well, hey, it's just that's
Yeah, I don't want to get
yeah,
political. I feel
yeah,
like we might have a bit of a cost of living crisis on our hands.
yeah.
And home prices are lumped in with that as well.
Well, I know with a lot of my friends, we're all Gen Z right now, and it's been more and more common for a lot of people to stay with their parents throughout university. Meanwhile, the generation before, like the millennials, kind of the boomers, right? They moved out right as soon as they turned 18, but now it's just 6.8%. Or what's the price for the single family home right now? Kind of on
Average price that I found in our area for single family detached is 546,000.
Wow, that's insane.
Yeah, and I mean averages have there will be some houses in the millions, some houses at 200,000.
Fair.
But overall,
yeah. And what are the most significant trends you're seeing in the real estate market right now? Or you already answered that. How are these trends impacting buyers and sellers differently, and what should each group be aware of moving forward?
yeah, I think the biggest trend that we're all looking at right now is interest rates. During COVID, we hit pretty low lows around like people were getting rates at 1.5, 1.8, 2% was a really normal mortgage rate during COVID. And then they steadily rose to over 5% until they just recently started to come down. So yeah, rates are decreasing, which is a good thing. It means people can afford more. The payments should be a little bit more affordable. But there's also a supply and demand that happens there. If there is people waiting on the sidelines, they've been thinking about purchasing. Each one of those announcements for a rate decrease is a call to action for those sideliners to go, okay, maybe now's time to buy. Supply is a little bit limited. Demand comes in, prices go up. I actually did put together some numbers here just to kind of illustrate that as well. So let's say last year, a $500,000 mortgage over 25 years at 5.25, monthly payment on that, $2,996. Rates have fallen. So let's say that same house this year, you get a rate of,
slow down. So the house is worth 500,000.
call it 600,000, maybe $100,000 down
And then
payment,
the
but just the
interest-
mortgage.
Yeah, the interest is
5.25.
okay.
So let's say that's a hypothetical scenario, which is pretty reasonable from last year. This year, with let's say a 5% increase in prices, that new loan is now 525,000 over 25 years at 4.8. So the rate went down, but the price went up. So the original payment $2,996, the new payment $3,008.
Oh wow.
So in some cases, even though the rates have fallen, because the prices have gone up, you're kind of in the same boat as you would have been last year anyways.
Okay. What do you think the best course of action is right now? Let's say I was looking for a first home. Got a family. What's my first move?
Your first move is always going to be to get pre-approved, right? Go to the bank, get your pre-approval, make sure that it's a solid pre-approval. We see a lot of people come in and they go, yeah, this guy at this place told me that I can qualify for this much. And then you start crunching the numbers and you go, this doesn't look right, because they didn't pull credit. They didn't look at everything. They just gave them a number based on who knows what kind of math. And that can get tricky, right? Especially if you enter into a purchase agreement thinking that you're going to qualify for something that you don't. So you want to make sure that you get a pretty concrete approval. There is tools. I actually have a tool on my website, sharplending.com.
Okay.
You can go there. It's called the affordability tool, where you can punch in your income, the down payment that you have saved up, and some of your current liabilities. And it'll give you a pretty close estimate as to how much you would get pre-approved for. Still not a pre-approval because we have to pull credit, take a close look at everything.
Just a little estimate.
Yeah,
Okay.
but that'd be a good first step, right? Just go through the affordability calculator, see about how much you might qualify for, and then take a look on realtor.ca and find some houses in that price range.
That's dope, man. How did you make this calculator?
I made it like through some coding on the website.
Oh, dope.
Yeah, there's a lot of companies out there that have calculators that would do the same thing. But I thought it would be a good value add to clients to be able to provide that quote tool to just kind of get them started in the process.
Yeah, I've played with those the pre-approval calculators, and it's fascinating to see just like the different metrics that they use, kind of the credit score, like your income, kind of that they have debt in there too, eh?
Yeah,
Debt.
because what we're looking at is, among a few other things, is the biggest thing is going to be your debt ratios. So what that basically means is the ratio of expenses to your income. And when we're looking at a new purchase, we have to factor in what you currently have for liabilities. Do you currently have credit card payments, line of credit payments, vehicle loans, but also the new payments that would be in your budget if you were to make that purchase?
Yeah. Do you see like a certain demographic right now that's just the most reliable?
No,
No?
I don't think you can pinpoint any demographic to be the most like reliable or credit
Mm.
worthy. And often it's maybe even the opposite of what you might think, right? I've met people that make a lot of money and they don't qualify for anything because
Yeah.
they spend a lot of money. And then you meet people that make a modest income, but they save, they live within their means, they don't have excess expenses, and they would be more credit worthy than the other person.
What advice would you give to a young guy wanting to build a good credit score and hoping to buy a house, let's say 10 years later?
Okay. If we have 10 years, I would say first step is get your first credit card, probably
Mhm.
$1,000 limit or something like that. Make the payments on time. Don't spend any money that you don't have. When you get a credit card, just think of it as an extension of your bank account. You can't
Mhm.
spend anything that you don't already have in the account. It is nice that you get normally 21 days interest free on a credit card. So you do have 21 days to hold that credit balance and then pay it off with no interest. But that's the biggest thing is as soon as you go after 21 days, they do start charging you interest. So you want to make sure that your payments are in on time. And to some degree, especially with somebody just getting started, trying to build their credit, it's going to be a matter of time too, right? That's another thing that they're looking at. Okay, you have a credit card, you made 2 payments. We don't have a lot of data to say whether or not this person is going to repay. But 2 years from now, with no missed payments, that says a lot more about a person.
Yeah, that's fair. Kind of the reliability of it all. Hey, kind of.
Yeah, there's 5 things that we look at as lenders. They call it the 5 C's of credit.
Kind of the external factors.
What's that? Sorry.
Are these the? I think I read somewhere where you kind of the character capacity. Is that what you were gonna talk about? Or is
Yeah.
that's for later.
Okay.
Sorry.
We'll get into that.
Yeah. So, what external factors, the economic conditions, interest rates, are currently influencing the market, and how should potential buyers or sellers navigate them? And I know you said see above, but can you elaborate on that more?
Yeah, definitely. I think if you're a seller, you're in a good position to sell right now. There is,
Yeah.
a lot of homes are going in on multiple offers. So you have a lot of competition from
Yeah.
buyers to purchase that property. From the buyer's perspective, it does put more pressure on you because there is more competition to buy the property that you might want. There might be 3, 4, 5 other people at the same time putting in offers on that house. And that means you have to present a better offer than all 4 or 5 of those other people to get in. That might mean a shorter possession date. It might mean shorter condition dates, time to waive conditions for inspection, financing, any other conditions that you might have. You still want to make sure that you have those conditions and make a safe purchase. But your timeline is going to be a little bit shorter and you're not going to have the same amount of room to negotiate as you might have in another market where you're getting 10% under list. Most houses right now are selling at list or over.
Mhm. Do you recommend to buy a house that's fully built right now, or build a house from the foundation to the final product?
Yeah, I think it's just a personal preference at the end of the day and how much time you have, right? If you're in a position that you can wait 12 to 18 months for a build to go up and you get to kind of spec out that home with everything that you want exactly, it's a cool option. There's a lot of people relocating now from other provinces like in Ontario. They might not have that same ability to do so, right? If they're posted in Edmonton for work, you have to
Mhm.
buy whatever you have to buy.
Yeah, fair. From my personal experience with my family, they had said that it's actually a lot more expensive having it built rather than buying one that's already built. Now, because I guess there you have to get some construction workers and you have to just plan it all out. There's also the time effort of it all. Um, where do you see the most growth around the Edmonton County area?
Um, I would say a lot of growth is probably going to take place in some of the satellite cities, like Fort Saskatchewan. There's a lot of new development going on in Fort Saskatchewan that looks pretty promising. Um, North Edmonton, there's a lot of new development as well. All over Edmonton, really. I mean, we could do a better job of putting up more houses, but there's also only so much space, right?
Yeah, man. Back when I first, when I moved here when I was 9, all the way from the Philippines, Sherwood Park was like half its size. Now it's just ballooned. And like talking to just some of the people I worked with, they grew up in Sherwood Park and around the Edmonton area too. It's just continuously just growing. Hey, there's just so many more houses getting built. You grew up around here, hey, or a small town?
Yeah, I grew up in Tofield. I spent a lot of time in Sherwood Park. Actually, a friend of mine lived maybe 9 houses down from here.
Oh, okay.
So I spent a good amount of time in Sherwood Park, and I used to work in Fort Saskatchewan as well. So, I think some of the satellite cities like Sherwood Park's pretty developed. Fort Sask has a lot of room to grow as well.
Mm-hmm. When do you think? Do you think Sherwood Park will ever start building up? Does that turn into like a city in itself, kind of like an Edmonton area? Is that like, how does that work? Because I know once you run out of room, hey, they just start building higher and higher.
Well, you're seeing it in Edmonton. The infill builds are getting a lot more popular because you're not taking up as much lot space, but the houses build a little bit taller.
Yeah.
So to your point about building up, I mean, when you don't have any room out, the only way to go would be up. It's a possibility.
Yeah, dude, who knows? 2 decades, 3 decades from now, hey? Let's get into mortgage financing tips and strategies for first-time homebuyers. Let's first talk about kind of the opportunities at hand when it comes to saving up for a first-time homebuyers plan. I know Alberta just rolled out with an FHSA.
Yeah.
And then there's also the RSP, where you could use your money from there to apply to combine the FHSA. Can you kind of elaborate on what those go about?
So the FHSA's kind of changed the game plan for first-time homebuyers in a really good way. You're allowed $8,000 per year that you can deposit into that account. Let me just start off by explaining how the TFSA and the RSP work first, because we have a third tax benefited account now. The TFSA, the money that goes in is already taxed, right? You get your paycheck, they take the taxes off, goes into your bank account, and then goes into your TFSA. But the money grows tax-free. And over the long run, like we talked about with compound interest, the growth is likely going to be a lot more than the deposits. So there's a lot of potential for tax-free growth. The RSP, the money that goes in, you get a tax deduction for that. So let's say you make $100,000 a year, you put $20,000 into your RSP, you're now taxed on $80,000 of income. So you get a tax break up front. And as it grows, within that account, there's no tax liability. But in retirement, when you go to pull those funds out, you will be taxed at your regular tax bracket, whatever your income is at that time. And now the FHSA does both for the purpose of purchasing a home. So you get a tax deduction for the $8,000 that goes in. It grows tax-free, and you also can pull it out tax-free only for the purpose of buying your first home. Whereas prior to that, the only option that we had would have been the RSP homebuyers plan. They recently changed the limit on that, so you can now actually pull out $30,000 per individual, I believe, 30 or 60.
You have to get that replaced though, around like a certain number of years. Hey,
yeah, you have 15 years to pay it back. Otherwise, you're subject to some penalties.
Yeah. There's all of these opportunities and chances to be able to save up that much. And I feel like that's just not taught in school. But a lot of people also get the misconception that the TFSA is a savings account, and then they just plunk money in there and it just sits there. But like, what do you recommend people do when they put money in the tax-free savings account? Or
I'm glad you talked about that. It's something that I used to see at the bank a lot and really grinded my gears a little bit, because you're right. The money in the TFSA, if you just leave it there, you're not getting any benefit out of that account at all. Because if it's not growing, there's no tax-free growth to take advantage of. So, I mean, the strategy really would be to put your highest risk investments into the TFSA, because it has the most potential for growth, and you're trying to capture tax-free growth. So your riskiest allocation should probably go into your TFSA, maybe a little bit less risk in the RSP. It's a personal preference. But that would be how I would use the TFSA, is take whatever allocation of my portfolio is going to be the riskiest and put it in that account that has the potential for that tax-free growth. Because if your bet pays off and your account grows a lot, that whole growth is tax-free.
Yeah. And especially for young people, like people under 30, like it's great to have that, because we're just living longer and longer. And it's definitely just a guarantee. If you play with the compound interest, for those of you listening, watching, you're just a guaranteed millionaire by age 50, 60. If you play around with it, depends on, how much you put in every month. Yeah, it's just a no-brainer.
I think I have an example here, actually.
Yeah. And dude, that's we need to leverage that.
So maybe $2,000 a month is a little bit out of most people's budget, but just for numbers' sake, $2,000 a month at 8% compounded over 25 years is 1.9 million. 1.3 million of that is just interest. So on about $600,000 worth of deposits, you're gaining $1.3 million in interest.
That's nuts, man. That's awesome. Like, it's so far in the horizon. Like who has a couple decades, 3 decades? No, you have a couple decades, 3 decades, because you're probably going to be 50, 60 one day, and you're just going to wish that you planted that seed when you're in your 20s, even for like 18, as soon as possible. Like you can even, I know for a TFSA, you need to be 18. That's when you have the kind of the contribution room is of that year of when you turn 18. But then for an RSP, you could get your parents to. That'd be really hardcore though. I know if you're investing before 18, that's next level.
And there's people that do it, right? Parents will open up even a non-registered account for their kids just to set aside birthday money and invest it.
Yeah.
Because to your point, you think, okay, if I start at 20, by the time I'm 42, maybe I can be a millionaire, right?
Yeah.
What if you start at 10?
Oh, dude.
Even with $50, $100, it adds up quick.
I know, you ever read Warren Buffett's autobiography? Bro, that guy was investing when he was like 12, and he was like putting gumball machines in barber shops when he was in elementary, man. Like how like he was just like ahead of his time, and he just consumed every single financial book there is. And yeah, man, if only I just started, put all my money into Google or something when I was like 10, or I guess I don't want to do crypto, but
shoulda, woulda, coulda though.
Shoulda, woulda, coulda, right?
Yeah.
That's for anything though. That's like for the relationships. That's for like, especially finance, but like just education with anything. In hindsight, it sounds so. It all makes sense, but when you're in it, like right now, we don't know whether Tesla is gonna take off or the housing market's gonna plummet. We don't know. It's like that uncertainty, right? But throughout history, like throughout the Great Depression, throughout even the 2008 financial housing market, and even COVID, you see the companies that have succeeded, and you see how the market in the housing fluctuates, and you could kind of give a good estimate as to what's going to happen. And people are always going to have homes. People are always going to go to Walmart and buy food, and then just buy kind of instead of having that due diligence is keeping it simple. Because I know a lot of people, I know we talked about it in the phone call too, is if you can't explain kind of your investment, whether it be housing or whether it be like stocks, to a 5-year-old, then you probably don't know much about it.
Yeah. No, I couldn't agree more. And I mean, some investments might be too complicated for a 5-year-old. But if you are truly honest with yourself and you really don't understand the underlying asset that you're putting money on,
Yeah.
it's probably not the investment for
Yeah.
you.
Like even Intel, like I don't know much about like semiconductor processing chips, and I was watching like a bunch of YouTube videos and like this guy talking about like, oh, buy Intel, and I'm sure it's it's in the S&P, but I just don't understand it. So you same with Bitcoin. I guess that's my mistake. I bought some and I lost $2,000. What are some of the most common mistakes first home buyers make when securing a mortgage, and how can they avoid them?
Yeah, I think some of the most common mistakes that first-time home buyers are making, the first one is you're not factoring in all the costs that are associated with home ownership. It's easy to go online to the calculator, calculate out what your mortgage principal and interest payments would be, but you also have to consider property tax. You have to consider home insurance, and then really maintenance costs are going to be a kind of a slap in the face to anybody that's been a renter in the past for a lot of years. Your fridge breaks, that's on you. Your furnace breaks, that's on you. You own that property and everything in it, so you're responsible for any of the repairs.
Yeah, you're right. Like, sure, there's buying the kind of the foundation of it all, the house itself, but then you need furniture. You need the garage maybe needs a little bit of renovation, and maybe the ceiling needs a little bit of kind of updating. Maybe there's some mold in there. You need to hire all these people. And if you don't have the skills to fix it yourself, you're going to be, you have to call some contractors, whether it be about the plumbing, whether it be about the electricians, and kind of the heating. If the heating, and if you want an AC, right, for the summers, that's for your comfort. Definitely, that's a big issue that a lot of people don't think about. Can you share some tips on how first home buyers can improve their chances of getting approved for a mortgage with favorable terms?
Yeah, definitely. There's 5 things that we're looking at, as lenders to assess somebody's credit worthiness. They call it the 5 C's of credit. So there's character, capacity, credit, collateral, and capital. Character is just kind of like a bundle up of all the other ones together, right? If we look at this person as a whole with their whole situation in mind, how do we feel about it? Capacity is going to be the most important one. And that's essentially just the debt ratios that we talked about: total debt servicing ratio, gross debt servicing ratio. There's really strict rules if your down payment is less than 20% as to what those ratios have to be, and they can't go over. If you're willing to put down 20% or more, you'll get a little bit more wiggle room to work with. But at the end of the day, it's income versus expenses, and it's a ratio. And there's a certain amount that we're looking for that needs to be in excess of your debt to pay off the mortgage that we're proposing. Credit, we touched on briefly. Make your payments on time. Don't miss payments. Utilization is another important thing. So let's say you have $50,000 of credit available to you between credit cards, line of credits, whatever it might be. Ideally, you're not using more than about $10,000 of that at any time. If you're using 100% of that, it kind of shows us that, okay, the more we give this person, the more they end up using. And eventually that's going to come to a head, right? And it's not going to be pretty. So we want to make sure that you're using a reasonable amount of credit that you're allowed to use.
Yeah, there's definitely like a lot of self-discipline in there, hey? Does that kind of tie in with character?
Oh, definitely, right? That it definitely ties in with character.
Yeah.
The next one down would be collateral, and that's just the value of the property when we're talking about secured lending. The value and also the property as a whole. Is it? Are there any adverse features of this property that we might not want to take collateral on it for that reason? There's always a product that we can find to fit. But if a house is non-conventional in some way, or there's some major issues in the house, why would we want to hold security on a property that really doesn't have any value? Because if something did happen and the bank owns it and we had to sell it, well, now we have to sell it with a moldy ceiling or, et cetera, right? And then the last one that we're looking at is capital. and that's just net worth. So assets minus liabilities. If we want to take a deeper look at that, it's going to be how much of that is liquid as well, right? You might have a lot of funds locked in retirement account, or, a lot of people have a high net worth because they own a property or properties, but how accessible is that money if something happened and you needed it to pay?
Your net worth could be 2 million, but if you need to pay someone up, you have zero upfront cash or just in your bank account to be able to give them that money. Like, no, you can't just sell your house in a day.
Yeah, exactly.
Right? Like when somebody says their net worth's this, is that like, what are we talking about? Like, are we talking about like your cash in the bank account, or are we talking about your properties? And certainly when when people talk about their net worth, it's always so ambiguous. It's like, what exactly are you talking about? So you said capacity is the most important. Yeah.
I would say with secured lending, capacities, and probably most lending, but secured especially, because what we're really looking for is, does this person have the ability to repay the loan more than anything, right? Maybe you have some issues with your credit in the past. There's certain things that we can kind of look over and explain as to why it might have happened. That's the big thing too, right? Why is there issues on your credit report? What's the story behind that? Did you lose your job? Did, COVID, were you impacted by that, right? Where we understand that everybody's human and people make mistakes. But capacity is going to be the biggest one, just in terms of, is there enough money at the end of this person's budget to afford these mortgage payments?
Okay. And let's summarize all 5 of those. So let's start off with the first one.
Sure.
Again, to keep it kind of for the people that still don't understand it, kind of to keep it simple for them.
Yeah. So character is just who you are as a person from what we see in looking at your finances. Capacity is the ratio of income versus expenses. How much income do you have left over after you have to pay all of your expenses? Credit is, your credit score, but also your credit history as well. Do you have any missed payments? How do you use all the credit that's given to you, or do you use a reasonable amount? Collateral is the security that we take against, in this case for this conversation, the house. Is there any adverse features of that property, or would it be easy to resell? And then capital is your net worth, and how much of that is liquid, how much of that is tied into properties or vehicles.
Yeah, that's very helpful. I think a lot of people should really know that, and to be able to plan out their future, because it's not getting cheaper. I don't want to get political too, but it's just, we live in a time right now where you really need to live below your means, and you need to armor yourself with that knowledge.
And to your point, isn't it funny that these are things that aren't really talked about in like junior high school for the most part? No,
none. I mean, we did, you guys ever have comm class?
Yeah.
It was just, it was all very general, but it didn't really teach kids anything. But yeah, to actually learn about this, even like the general kind of liabilities and assets, and even the philosophy of living below your means, like that's like very popular in the finance space of things. Of like, don't spend more than what you earn. Like, don't pay off your credit card on time. Invest a little bit. All very general, very simple. Like, you don't need to have to be Einstein to be able to understand this. And a lot of the kind of the philosophy of like a lot of successful housing investors and even stock pickers, a lot of them just say keep it simple, just simplicity.
It is simple, and I think for a lot of people, most of what you said is pretty intuitive as well, right? Spend below your means, don't borrow money that you can't repay back, but you also have one life to live, right?
Yeah,
tomorrow's not guaranteed, so there's a balance to be struck in getting enjoyment out of your life, and doing everything that you can in the 24 hours that you have, and setting yourself up for success in the future.
There's this quote, I'm sure you've heard of the term delayed gratification.
Of course.
And then delayed gratification in the extreme results in no gratification. Because you have all these people, like, you ever heard of the FIRE movement too?
Yeah,
like
retire early is the
yeah,
RE.
yeah. Financially independent, retire early. A lot of these guys, man, take it to the extreme, like sacrificing relationships just to save $10. And while that does, if you play with a compound interest calculator, that does go a long way. But it's you shouldn't sacrifice your relationships and your well-being and your health just so you could, be financially independent one day.
I'll give you another analogy that I like to use too is look at life as a three-legged stool. Each leg is represented by one F. The first F is friends or family, right?
Yeah.
The people around you, your relationships. The next F is fitness or your health, right?
Mm-hmm.
And then the last F is finances. So you need to make sure that all three legs are sturdy to hold up that stool of life. It's great if you have excellent fitness and health and your finances are perfectly in order. You're making tons of money. You're saving tons of money, but you have no friends or family to show for it or spend time with. And you can do that with any combination of those three, right? If you're very financially well off, and you have lots of friends and family, that's great. But how's your health?
And you're just stuck bedridden. I actually, believe it or not, I came up with that in my own head, and I thought it was like the most original thing. Like, man, I thought like I was some sort of philosopher. This is back when I was 19, first started investing, and I had just read Rich Dad, Poor Dad, and I was like reflecting on my life, and I'm like, wow. Then I got more into it, and I'm like, fuck, like there's already people that have come up with my idea.
There's no unique thoughts left. We've thought all of the thoughts.
Yeah, but no, it's a great way of looking at it. Because I guess finance isn't everything, right? But it is such a crucial way of being content and living a fruitful life. What's kind of your favorite philosophical kind of narrative when it comes to finance, and what have you derived the most out of being in the finance space and applied it to your life, whether it be about relationships, whether it be about education, family?
I think it really just comes down to balance. Like I said, I've seen people's profiles where they make way more money than you could even imagine somebody makes, but they're not doing good financially.
Yeah.
And vice versa, right? And also too, sometimes you meet somebody, and in this job, at least, you start to imagine, okay, this is what I think I'm going to see when we take a look. And it's never what you think, right? People present themselves in a type of way, but you can't make a connection to what their finances look like at all.
I've heard this saying often, that the rich act like they're poor, the poor act like they're rich. And from what I've seen, it's actually very evident. There are the few cases where that isn't true. But for the most part, I see a lot of people that have all the luxury and have all the kind of the townhouses, and it's all on their name, but then they actually carry so much debt. Or you got the people with like Ferraris, Lamborghinis, or like the people with like designer clothing. But then you see the guy with just shorts and a plain shirt.
Yeah, Adam Sandler wearing a Superman t-shirt and basketball shorts.
Yeah. Or even like you see Mark Zuckerberg. Right? He's just like, he's kind of the one that's normalized just the shirts and some sandals pulling up. I think he pulls up in meetings like that. That's what I've heard.
I read something about him that said he has a selection of one type of shirt, probably one color too, because it's one less thing for him to have to think about when he wakes up in the morning.
Yeah, dude, when you're that high up and you need productivity, like people like, you ever heard of Alex Hormozy?
Yep.
Yeah, he wears the same. He kind of talks about the same thing where he like wears this this tank top, and he wears like this flannel, and he wears shorts, and he says, yeah, when he goes to the gym, he could just take off the flannel and it's like a gym outfit. But then when he goes to a meeting, he could put the flannel. Goes to a restaurant, he can just put it back. It's just when you're making that much money, you're dialed in for productivity, and you do what's best for you, eh?
We also talked about brand too, and that's another thing, right? Zuckerberg's brand now is that he's the guy that shows up to meetings with a t-shirt. For better, for worse, that's memorable, right? Hormozy, not that you would miss him in public. He's got a pretty distinct look.
Yeah.
But you're not going to catch him not wearing that tank top. Like you said, that's his brand. That's how people recognize him.
Yeah, no, it's a marketing scheme too, hey?
Mm-hmm.
I mean, and you see that guy, it's just that's kind of just very clear. Or if you see like a lot of the people who just dress a certain way, and then you just like they keep it simple and they keep it consistent with who they are. It's just, it kind of relates back to, sorry about that.
No,
it relates back to kind of keeping it simple too, and kind of adopting that philosophy even when you dress. What type of mortgage products should first home buyers consider, and how can they determine which option is best for their financial situation?
For first-time home buyers, the majority of them at least are probably going to fall within that less than 20% down payment, which means they're going to have to consider default insurance. It's a little bit difficult to understand because it does range. Basically, the closer you are to 20%, the less you're going to have to pay on that default insurance. And the closer you are to 5%, which is the minimum down payment.
What is default insurance?
So default insurance is basically what it is insurance for the bank that insures them in the case of you defaulting, which means not paying your mortgage back. So for example, let's say we have a $100,000 house and you put down 5%, your loan to value is 95%. There's $95,000 loaned and there's 5% or $5,000 in equity. If you never made a mortgage payment, we gave you the mortgage and you just walked away, you never made a single mortgage payment, and we were the bank, had to recoup our funds, we don't necessarily have enough room to recoup our full funds because there's legal fees. We have to pay a realtor to, list that property and sell that property. There's costs to that, which are probably going to exceed the $5,000 that we were given down. So what default insurance is it's insurance for the bank that you pay for, which is kind of interesting. But you, the client, pay for insurance for the bank in the case that you might default. The bank gets their full money back.
Is that mandatory?
Mandatory for down payments that are between 5 and 20%.
Okay. I know there's also a rule where you can't have it rented out if you if you pay a 5% down payment. Okay. Is that true?
That is correct. Generally, rental properties have to be conventional mortgages, which is 20% or above.
Mm-hmm. Is it common for people to do 100% just pay in cash, or not cash, but in like liquidity?
I don't know how common it is. I think you could also argue that there's potential for those that money to earn you more interest in the market than paying cash for a home, right? Nobody would think twice about financing a vehicle at 4%, right? Especially when their investments are earning 8 to 12% in the market. It's kind of the same rationale with mortgages or purchasing a home. If you're paying 4% on a mortgage, but you can get 8 to 12% in the market, you're essentially pocketing the difference on any money that's allocated to your investments instead of to that 4% mortgage. You're kind of using it as leverage in that case.
Oh, beauty, man. That's awesome. Yeah, bro. I kind of just apply the same kind of mentality when it comes to finance and like fitness, even relationships, where it's just constant improvement every day. Okay? And I'm sure you're the same too. Hey, once you learn more about this space, there's just you realize that there's so much to learn, man. Like I think we mentioned that, and we talked about that during the phone call yesterday.
Yeah, I think being a lifelong learner in any industry is going to pay you dividends, right? And the world and society as we know it always is changing, and currently is changing probably faster than it's ever changed before, which means there's always going to be opportunities to learn.
Yeah. You are very literate, very succinct with your speaking. Now, what would you advise the people who want to get into real estate or mortgage financing to be able to improve their communication skills?
I'm going to give a piece of advice, and it's kind of a do as I say, not as I do kind of thing. I've never done a lot, at least, of door-to-door marketing, but I have to imagine that is probably the quickest way to get used to talking to unfamiliar people.
Like
and
cold call, like door to door?
door to door. Yeah.
Okay.
You know, like a telesalesperson or something, go door to door, get rejected, spend the day getting 25 doors slammed in your face until you get that one person to say yes. And then really hold on to that, because you're going to find another one eventually.
Yeah. I think with the rejection, a lot of people can't stomach it. Like I've never been in sales, but it's just, have you ever listened to Scott Galloway?
Yeah, he's a little bit older, right?
Yeah, bald guy.
Yep.
And he's a very successful investor, and he talks about rejection, and he kind of relates the finance world in terms of kind of relationships too, where like for men, it's just you need to be able to put yourself out there and not fear rejection. And he applies this to sales and to just put yourself out there, to not be afraid of what they're going to say, and to be comfortable in your own skin. Because when you're dealing with kind of the finances, it's a very soft, like with people, it's a soft spot.
Yeah,
right?
it's a touchy subject.
It's very touchy. Like if you're asking someone about how much money they make,
Mm-hmm.
I'm sure it could aggravate some people. Some people won't have the best kind of headspace. How do you deal with that?
I just always try to provide the best quality of service and the best advice that I have to offer. And sometimes people disagree, and that's fine, right? But if I have an idea that I genuinely feel is going to make the biggest impact positively on your finances, I'll present that idea and I'll push for it. But at the end of the day, if a client or somebody says, no, I don't want to do that, we'll break down, why don't you want to do that? Because maybe you're not fully understanding this. And at the end of the day, if they don't want to do it, they don't want to do it.
Fair. Yeah. Let's talk about using mortgage loans to make real financial progress. How can homeowners leverage low mortgage rates to maximize their investment contributions or financial growth?
Yeah, this is something we talked about a little bit. Here's a fun thing. So money is what's called fungible, which means each unit is interchangeable with another unit. So a $5 bill in your right pocket is worth the exact same as the $5 bill in your left pocket, right? If you drop a $5 bill, but you find another $5 bill, it's still $5. Doesn't matter which bill it was.
I mean, if it's Canadian or US though.
Sure. Yeah, definitely. So exactly. And then where that changes when you start adding a variable into that, like an interest rate, right? So let's say your left pocket, your mortgage costs you 4.5%. But your right pocket, your investments, you could be earning 8 to 12%. If you look at it, any money that's going into your right pocket, you're gaining 4%, right? You could put it onto the 4% mortgage that you're paying, but you're actually going to gain 8. So 8 minus 4, your total gain will be 4% difference. So when people look at paying down their mortgages early, which is a personal preference, right? If you want to be mortgage free and debt free, there's a lot of value in that, and there's something to be said about that. But a lot of the time, from a numbers perspective, those extra payments towards your mortgage at 4% could earn you well over 4% in the market, and you would get to pocket the difference.
That's interesting. How did you kind of, to summarize that? I kind of get what you mean, but I'm just like having trouble kind of fully absorbing what you had just told me.
I think I brought here's an example of that.
Sure.
So let's say your mortgage is $525,000 over 25 years at 4.8%. Regular payments are $3,000 a month. If you put in an extra $2,000 a month your mortgage would be paid off in 11 years instead of 25, and you would save $220,000 worth of interest. So the total amount of interest you would save by putting in that extra 2K per month, 220,568. If instead of doing that, and we talked about this, the compound interest, you take the 2,000, invest it monthly at 8% over 25 years, you would earn $1.3 million in interest. It's the same sheet that I showed
so
you before.
Take that instead of just fully paying it off, you put that in something that can grow.
And as long as the return that you're getting from the market is greater than the cost of the interest on your debt, you get to pocket the difference.
Okay. Oh man, dude. Do a lot of people that you talk to know that?
I don't think a lot of people think that way, and also a lot of people are really resistant to that too, because you get it in your head that your goal is to be mortgage free, and that's what you want to do, and that's fine. It is a personal preference, whether you want to invest the additional funds or you want to pay off your mortgage faster. There's a lot to be said about being debt free, but when you lay out the numbers from just strictly a numbers perspective, that money goes a lot further for you if you were to invest it and hopefully get pretty positive returns versus, even at 4 or 5%, pretty cheap interest rate.
What would you say to someone who is skeptical of the returns, and they're scared that a bear market's going to come and they don't fully trust it? What would you say to that person?
Dollar cost average, which means you're always putting in the same amount of money consistently, whether the market's up, down, or trading sideways. And you're going to get an average dollar cost of, per unit of that stock or that ETF. What that means is when it's higher, you're still buying in, and you're buying in at kind of a high price. But when it's lower, you're buying in as well, and you're buying in at a discount. Because you can't predict when it's going to be up, when it's going to be down, you just buy in consistently to get the average movement of that chart or that stock. Yeah.
And when the stock market does go down, Warren Buffett says, be fearful when they're greedy, be greedy when they're fearful.
Yeah, exactly. Or you said scared. Yeah. Somebody, I don't know who says scared money don't make money, but.
Yeah. What else? He says that Warren Buffett says that the stock market's the only place where when a product goes on sale, people don't buy it.
Yeah.
Yeah. And because you see, like you go to Best Buy, you go to Amazon, their Prime Day, Walmart's, and this discounts. People are just buying all this stuff because, it's like 50% off, 60% off. But then when an ETF is 30% down, people are averse to it. It's crazy, kind of the behavior side of the stocks or the market.
Yeah, and it's how it's presented to people too, right? If you walk into Best Buy and there's flashy signs everywhere that say sale, buy this now, it's probably the direction that you're going to go. But if you go onto Yahoo Finance and every headline says markets are crashing,
we're doomed,
pull out all your money,
sell everything,
right?
I know you're gonna dollar is going to zero.
Yeah.
I'm also under the impression too is if push comes to shove, and let's say the stock market, the percentage points drops by like something crazy, like 3,000. Like let's say the dollar actually goes to zero. There's probably something worse to worry about, right? Let's say Amazon went bankrupt, Apple went bankrupt. That would be some crazy stuff happening in the world, man.
I've always said the same thing to anybody that has a good amount of time that they can average out their returns in the market, but they don't want to because they're scared that the market's going to go down. Maybe you get a bad 25-year run. There hasn't really been any bad 25-year runs as far as I know. Maybe you get a bad one. But to your point, if the top 500 companies in the US fell to zero or close to zero, that would be a doomsday scenario. We would have way bigger problems than the number in your Robinhood account.
Yeah, no, stop worrying about finances at that point.
Right.
Your people are out in the streets. It's absolute anarchy. If
we're hoarding toilet paper.
Yeah. That's when the time where I'd actually just be terrified. What's for a person that doesn't know anything about investing, where would you have them start?
I think you would want to sit down with somebody that you trust, that you feel does know what they're talking about. And my advice for people that don't know much about investing is just learn the bare minimum to understand what investing in broad market indexes means. You know, like the Buffett strategy, how he said ETFs are going to beat out hedge funds, and they did, right? You're buying into a bundle of companies. In the case of the S&P, the top 500 companies in the US, they choose the allocation. So it's not like you have to go, okay, well, am I going to put $1 into Apple and 50 into Nvidia? The allocation's set for you. And you're making a bet that these 500 companies are going to perform, you know, over the next however much time you have. Where people run into issues is when they get their first trading account and they go, okay, I'm going to pick some stocks here. And then they start Googling, or they go on Reddit and get some due diligence from Reddit, God forbid.
On YouTube, see that, oh, this guy, he seems really confident.
I think there's a stat out there that over 90% of retail investors lose money, and it's because they're picking stocks, right? So I don't pick stocks. I don't believe personally that I know enough to be able to pick winners and losers, but I'm comfortable making a bet that the market's going to continue to perform at around the same level that it's been performing in the last 50 to 80 years.
Yeah. Bet on kind of globalism, bet on the S&P, bet on kind of the companies that have been around since we were born, have survived the Great Depression, have survived just absolute, just pension wiping, kind of deep, like really deep bear markets, that just the companies that do survive those times and put them in a basket where you can invest. That's just a no-brainer. You see kind of like with the, I know VFV.to ticker, that's a ticker symbol for anyone that doesn't know what that means. That's kind of the little symbols that is listed out. If you go on Yahoo Finance, or if you Google a stock, VFV.to would be an example of an S&P ETF that you could invest your money in, dollar cost average, and just put money in where you don't need it. Like, you shouldn't put in your daughter's college savings or your kind of the medical emergency where might need it, right? Put in money where you're not gonna need it.
Yeah, the textbook answer would be to say you don't want to invest anything until you have 3 to 6 months of living expenses saved up in like a high interest savings account that'll earn you something, not much, but it won't lose anything either.
Yeah, there's a lot of kind of that safety net. Right? A lot of people don't have that. So when they go into it, and let's say we are at a bear market, and you'll need to liquidate that, and you're doubling the loss because you don't have that safety net. What are some strategies for using home equity to fund other investments or financial goals without overextending oneself?
I think using home equity or home equity loans is a really good option if you're looking at funding some renovations, you want to develop your house a little bit further. It's also a really good option to refinance some higher interest debt. Say, you buy a house, like you said, you have to buy some furniture, some things go south, a furnace breaks here, whatever it might be. There's costs that you might incur that maybe you do have to carry that on a line of credit cards. Well, once you've built up equity in the house, you can then reborrow against it, absorb that debt that's maybe 10%, 15%, 20%, and include it all together in your mortgage at 4-5% and save a lot of money by doing it.
So how can someone balance paying off their mortgage versus investing in other opportunities? And what factors should they consider?
I think they should consider their personal risk tolerance, right? How much do you want in the market? How much are you comfortable withstanding the ups and downs of the market? And also, what are your priorities, right? There's finance and then there's personal finance. And the personal is key. If it's your goal to be debt free, by all means pay down that mortgage as fast as possible because that's your goal, and we want to see you hit that. But if it's your goal to retire with X amount of dollars, maybe that money's better put in the market than as additional payments to your mortgage.
If you're also approaching 60, then it's going to be a whole lot of a different investing strategy, even in the housing markets or whatever the plans that you have, right? It's really having the time to self-reflect and to, okay, where am I going to be in 10 years? Am I even going to be around? Like, am I healthy enough?
Mm-hmm.
Right?
What do I want to do with the rest of my life?
Yeah. And certainly going into it just because society tells you, oh, it's a buyer's market, and could set you up for a disaster.
Yeah, definitely. And I think people that are approaching retirement too, they're likely the demographic that's going to get the most bang for their buck out of some kind of financial advisor as well. We've talked about these common sense investing strategies, invest in the overall market, dollar cost average for 25 years. And, as long as hopefully the world doesn't fall apart, you'll probably end up with a good amount of retirement nest egg. But once you start approaching that time that you need to start drawing from these accounts, there's taxation implications that need to be considered, and all the things that come along with that, where maybe it is, depending on your circumstances, a good time to bring in an advisor to come up with the best game plan of, okay, what accounts are we draining first? How much are we pulling out? What do you guys want to get done here?
Mm-hmm. Yeah, there's definitely a lot of opportunity on there too. Where would you say the best bank is to? Does it matter if I go to RBC, BMO, or TD? How do I know?
Maybe I'm obligated to say the Bank of Montreal here. I'm not sure. I think the banks are regulated under the same regulator. So a lot of the things that you see in terms of like we talked about, debt ratios, stuff like that is going to be pretty similar. Products are going to be pretty similar across the board. But every bank does certain things differently and better, right? BMO's has a good partnership with the Canadian defense community. We offer really good incentives for the Canadian defense for their mortgages, their investments, their accounts. I don't know a lot about what the other FIs do, like under the hood, but maybe there's certain programs for other sections of Canada that you'd really benefit from by being a part of that bank. But yeah, it's you'd really have to weigh all your options at the end of the day. And there's also nothing wrong with spreading yourself out too, right? Maybe you have, your checking account at TD, or I'm making stuff up. Maybe it's TD because they're the
Yeah.
cheapest or something, right?
Mm-hmm.
But you're Canadian defense, so your mortgage goes to BMO because you're going to get a cheaper rate. So
Yeah. There's also kind of the mistrust with banks now too, I find, especially with crypto coming to fruition. Can you tell people that aren't aware of kind of the insurance policies? Because I know there like like all banks pretty much, like the mainstream banks that are like RBC, TD, BMO, kind of the Canadian National Bank, they cover like a certain amount. Say if a hacker comes in
Mhm.
and loots you, can you go and
yeah, it's called CDIC insurance, and you're insured for I believe it's $100,000. Again, to my point about maybe spreading yourself out, that's per bank. So if you have $400,000 that you want to make sure is fully insured, that if any bank fell apart, I would say the best thing to do is put 100 at TD, 100 at RBC, 100 at BMO, 100 at Scotia, and take advantage of that deposit insurance at each institution.
Yeah, I'm sure that also goes for investing too. Hey, like putting all your money into Wealthsimple or Questrade or RBC. Yeah, you need to be able to. Sure, there is a lot of trust in those banks, but you never know, and it's good to kind of diversify. And yeah, that kind of protects one from the chaos and the uncertainty of it all. But yeah, man, thank you so much for coming on the Long Term Podcast.
Thanks for having me. I had a blast. Maybe we'll have to do this again sometime.
Yeah, we might have to, man. See what the market's looking like for the year from now or something, or maybe something big, and you'll have to give me a breakdown and everything. And are there any last words to the listeners or viewers that may have that they don't know anything about finance and they want to get into it, or they just don't know where to start, or no confidence? Like, how would you advise them?
Yeah, if you're looking for some general personal finance advice, feel free to reach out to me. If you're looking to get pre-approved for a mortgage, then I'm definitely happy to help as well. Check out the website, sharplending.com. There's a lot of tools on there, mortgage calculators, affordability tools, and some applications that you can fill out. But yeah, anytime, anybody, feel free to reach out. I'm happy to help.
Awesome, man. This is Lincoln Sharpe, everyone. And yeah, as always, to everyone listening and watching, there is a place for you in this chaotic world. Never lose hope. Strengthen your faith and keep it long term. Peace.
Peace. What do you think?